Welcome to Economics. Today we are going to look into economic cycles. We will be exploring its different stages and discussing where to allocate your resources based on the phase of the economic cycle we are in. The economic cycle is composed of four phases: recovery, expansion, slowdown, and contraction. Each phase has distinct features that affect investment strategies. We will analyze each phase focusing on income, employment, consumer confidence, and spending on consumer durables and non durables, as well as services. During recovery, unemployment remains high, consumer confidence starts to improve, spending on consumer durables like autos, motorcycles, appliances, and furniture is often postponed, as well as spending on services is low. During the expansion phase, hiring restarts and the unemployment rates begin to fall. People experience rising incomes. There are healthy employment prospects and greater consumer confidence, and spending on durables and services increases. During the slowdown phase, businesses continue to hire, but at a slower pace. The unemployment rate continues to fall. Incomes are still growing, and consumers remain confident. Household spending on durables and services stays high. In the contraction phase, businesses start laying off employees. Employment declines, and confidence weakens. Purchases of durables are postponed, and spending on services declines. So, what happens with the non durables that we talked about? Non durables, which include goods with shorter consumption periods like medicine, food, and household products, generally have stable consumption levels and do not vary much across the cycle. So, after we talked about the phases of the cycle, where should someone invest depending on the stage of the cycle? According to Fidelity Investment Research, we can see through this graph that during recovery and expansion phases, stocks have historically shown the highest outperformance relative to bonds and cash. In this other graph, we can see that inside the equity market, key sectors to consider include financials, real estate, consumer discretionary, tech, industrials, and materials. Examples of stocks include Bank of America, Starbucks, Nvidia, and Nike. In the last two phases, slowdown and contraction, bonds and cash tend to perform better. Inside the equity market, defensive and secure stocks are what investors should be looking for, such as consumer staples, healthcare, energy, communication services, and utilities. Companies like CVS Health, Walmart, Walt Disney, and ExxonMobil typically do well. Thank you for watching. If you enjoyed this video, please subscribe for more content like this. And as a bonus, I've included a link below to help you determine the current phase of the economic cycle.